Central banks in Africa's biggest economies are expected to raise interest rates this month to contain sticky inflation and deter a sell-off in their assets, exacerbated by the collapse of U.S. lender Silicon Valley Bank and stress at Credit Suisse Group AG. Nigeria, South Africa, and Ghana are among those projected to raise borrowing costs over the next 2 weeks. The ability of African governments to service their external debts will continue to be weakened by scarcer financing and higher interest rates. The U.S. Federal Reserve's monetary policy tightening and a strengthening dollar are having a knock-on effect on African countries' balance sheets and public debt burdens, according to a new report. Now, exposure to international interest rate changes is exacerbated by the large proportion of African public debt that is held in dollars. And now economists think the ability of African governments to service their external debts will continue to be weakened by, of course, that financing and higher interest rates. Now, joining me from Lagos, Nigeria, is Victor Aluyi. He's Senior Vice President and Head of Investment at Sankore Global Investments. Victor, welcome again to Business Edge. Thank you for joining me.
Good morning. Thank you for having me.
So now let's start with Nigeria, of course. And in terms of that conversation, the CBN's Monetary Policy Committee is on day 2 of their meeting. And this is the longest phase of monetary tightening in more than a decade that we've seen in Africa's largest economy. Rates have been increased by a cumulative 6 percentage points since about May. What should we be expecting at the end of this MPC meeting?
I think that you've absolutely couched it. We've been on a very, very aggressive monetary tightening stance for almost a year now, and I mean it's clear why that's happening. We've also been dealing with really, really high inflation as well. As a matter of fact, the monetary policy about 17.5 is about the highest that we've seen on record. We're also seeing record high inflation as well. So it's a really tough one. However, I think what is clear is the fact that, monetary tightening in trying to deal with inflation, particularly in our climate, hasn't exactly proven very effective. And we continue to see that, and we continue to see inflation remain, really, really resilient. So in terms of a decision, I do not expect any further hikes. Any further hikes would essentially really tighten already very tight monetary conditions. I think that there are, exogenous factors outside of, our monetary control that continue to pressure, inflation. Obviously, we're dealing with very high inflation globally. A sizable element of our inflation is also imported. So when you have this very high global inflation, it certainly will seep through to the inflation that we have locally. Obviously, all of the bottlenecks that we all with locally continue to put that upward pressure on that CPI. I don't expect any further hikes, seeing as we've taken that rate to the highest level that we've seen in quite a while. I think it probably is time for the monetary authorities to pause and maybe reassess the impact of what so far. Maybe also come up with some other moves that would help to address the inflation issue that we're having, because from evidence that we've seen so far, this aggressive tightening has done very little to bring inflation down.
And it's interesting you talk about both the domestic and the external factors, because I was going to ask about that, but also the fact that you feel like maybe we've hit the wall now and we expect the MPC to turn around. So what would happen if we've hit that sort of imaginary boundary and yet the MPC drills through and announces yet another rate hike? What do you think would be the impact on the economy?
I think it would just, like I said, it would just make already tight monetary conditions even tighter. Certainly loans are just going to get, repriced higher. It's certainly going to have an impact on the fixed income market as well, where you're likely to see yields, repriced higher as well. So those are some of the impact that you are likely to see in the aftermath of a further rate hike. But I think it must be put in perspective that what the monetary policy authority is basically trying to do is to tackle inflation. And like I said, I do not think that a further hike would help, bring inflation down. I think other means need to be explored to try and tackle this inflation. From what we've seen also, a lot of it really is out of the control of monetary policy tools, so it becomes almost counterproductive to continue to tighten monetary conditions when, inflation really isn't responding.
And so that takes me to also that with the previous hikes, you're expecting pause at this point, really see if you've gotten some of the expected returns, expected response from the economy and from inflation on that. But you also mentioned, of course, that a lot of this is beyond the monetary policy control tools that have typically been deployed. So then what avenues, what options are many MPCs left with, be it in Nigeria or Kenya, South Africa, if the traditional tools, and you're not the only only financial analyst economist to tell me this, that this is really not the way that things have been. It's not textbook. It's not just bring out these tools and then get the resultant decrease in inflation. It's not working like that. So what options are left?
Well, the truth of the matter is that if you look at the way that inflation works here, it has a lot to do with, the cost side of things and not necessarily the demand side of things. So cost essentially gets exacerbated as a result of all kinds of bottlenecks that create problems and then push up prices. So these issues need to be addressed. It certainly would take a concerted effort, not just from monetary policy authorities, also on the fiscal side and then policy as well, to ensure that, these exogenous or extraneous factors, their impact is sort of, checked. In the absence of that, really, there's just so much that monetary policy can do.
All right, so let's stick with Nigeria very quickly, because this is also the first MPC with the country having a president-elect, and the next one is going to be should be right at the beginning or very tail end of this administration heading out. But we have a president-elect in Bola Ahmed Tinubu of the APC who has promised to remove fuel subsidies and also carefully review and better optimize the country's system of multiple exchange rates, which he has described what falls under the CBN's policy as somewhat arbitrary. When you look at these anticipated and expected reforms, what do you think the impact will be on prices and inflation, and an MPC that will have to manage the impact of his decisions when he becomes president?
I think that, we're certainly going to see a knee-jerk reaction. That is assuming that these policies are certainly implemented. Again, like I've always said, the issue of subsidies is a very probably even more political than it is economic. Again, I don't expect that this thing will happen in one fell swoop. We're certainly likely to see a phased or a staggered approach to the removal of subsidy. The FX issue, of course, remains as well. I don't expect that it will be addressed again in one fell swoop. I think the major policy thrust there should essentially be aligning all of the several windows that we have to ensure that we have one window where people can transparently, exchange naira for the greenback. So again, if these policies are implemented as we've seen being touted on the campaign trail, I think in the long term it will certainly bode well for our economy. We would, however, have to make do or persevere with some short to medium term pain.
All right, so let's move now to Nigeria's neighbor and the second largest economy in West Africa, that's Ghana. And we know the country is still in the midst of an economic crisis, with fingers crossed on the IMF loan request. We've seen inflation decline for 2 straight months, and the currency has also been relatively steady this year, helping to keep inflation in check. What do you think policymakers will decide when they meet, I think, in about a week and a half?
I don't expect any major decision. The major issues that the country is certainly grappling with right now, it's debt restructuring. The finance minister essentially is off to China to try and renegotiate some of its loans from China. That, again, as part of a precondition to accessing the $3 billion from the IMF. There's still the China loan. There's still foreign creditors by way of Eurobonds. So that these debt renegotiations that need to happen, and those are, for me, by far more important than any monetary policy move that the monetary authorities in Ghana take at this point in time. And like you highlighted, yes, we've seen a bit of a deceleration in inflation, but nothing significant really. The currency has been stable, but it is important that these debt negotiations go well for Ghana, such that it is then able to access IMF funding and really turn the ship around and put it on a more sustainable fiscal footing. So on a monetary policy standpoint, going into that meeting, I don't expect anything significant to happen, because focus would certainly be on these debt renegotiations.
All right, so in terms of not expecting anything significant, that's a hold. You expect that Ghana's MPC is going to hold where they are, keep themselves in a holding sort of phase to see how things play out with the debt restructuring, the IMF request, and of course, both domestic and external bondholders who are still giving the government a bit of a hassle in terms of some of the arrangements the government is trying to put in place. Absolutely. So, yeah, I expect, the monetary authorities to be in a holding pattern.
the outcome really of these debt negotiations will prove very, very crucial, even more crucial than whatever it is that the monetary authorities do. So I think that it makes a lot of sense to put that in front of everything, make that priority, sort that out, and then we can start to figure out what monetary policy direction should take.
All right, now let's head to the continent's most industrialized economy, and that's South Africa. We've seen the rand battle itself and the dollar this year, weakening about 7% against the dollar so far in just about 2.5 or so months of this year. Average inflation expectations for the year stand around 6.3%, well above the central bank's target of 4.5%. Does the MPC really have any space here when it comes to interest rate hikes? We have a country that's battling record high unemployment as it is. Also, many socio-economic issues as it is. They're currently in the midst of a national shutdown declared by an opposition political party. You still have the president who is probably trying to hold on for his dear political life heading into elections. And then you have the power outages coming from Eskom. All of these are situations that are going to put pressure on the MPC. But what space do they really have?
Well, I mean, if you look at the trend, particularly in inflation, for instance, I mean, we've started to see some sort of deceleration. Inflation for January came in at 6.9%, down from 7.2% that we saw in December. However, that inflation is really coming down from the highest that we've seen since about 2009. So clearly, the economy has been quite challenged for some time now. The power outage really being a major headache that is beginning to seem sort of intractable for authorities to deal with. In terms of wiggle room for the monetary authorities, I think they would want to see how the inflation situation pans out over the next couple of months before they go ahead and make any move on the policy front. Yeah, we've seen some sort of weakness, particularly on the rand against the greenback, throughout last year, just about 7% thereabout. I don't think that is strong enough to create any near-term panic. I think that the monetary authorities will certainly want to see that inflation trend for another couple of months before they decide on what move to make. I think that the issues around policy, issues around dealing with the power, issues around dealing with the challenges that continue to bedevil Eskom are really paramount at this point in time.
Okay, so with that said, it looks like we expect a lot of holding from many of the big economies on the African continent when it comes to these next MPC committee meetings. But let's see what East Africa holds for us, and that's Kenya with the largest economy in that region. Some believe that it's actually a 50 basis point hike that would be the wise decision at this point in order to combat rising inflation and the weakening shilling, given that inflation has now breached the 7.5% upper limit since June. If we were to see a 50 basis points hike in Kenya, what impact do you think that would have on the economy? And is that really the way to go? A lot of Kenyan economists are saying it's only the real option that's left. Well,
again, inflation has been a problem, for Kenya. I mean, this time last year, headline inflation was just about 5.5%. The latest inflation data is running at about 9.2%, almost double what we had, this time last year. So, clearly, there to try and take care of that situation and ensure that you don't have a situation where inflation is essentially running away. And obviously, the toolkit there is to try and deal with it by hiking rates. If you also look at the cycle that Kenya has been on, we haven't seen it as aggressive as maybe in Nigeria, for instance. So there certainly is that wiggle room or headroom for them to go ahead and hike this time around.
All right. I mentioned, of course, the tools earlier. We might focus some of that conversation on Nigeria as we did, but across the continent, have we seen policymakers being able to employ any other tools in order to attempt to tame inflation?
I mean, the truth of the matter is that when it comes to monetary policy, you essentially have limited tools. You have interest rates, exchange rates, and you also have to deal with inflation, right? Your tools are limited. You have to use tools that either expand or reduce the supply of money, and largely it's around interest rates, really. So in terms of other toolboxes, other toolkits, there is a very strong limitation as to what monetary authorities can and should do.
So we've seen government bonds across the continent dropping, and I think they've dropped every day for the past 7 or so. So that's a massive thing that's happening for many of us. And of course, this debt burden conversation and the debts that African economies need to pay in the coming years, some debts coming due this year, some next year into the following years. In terms of having these conversations with the MPC and seeing a rise in the interest rates, how much bearing or what should we be preparing for, basically, as Africans and African economies, as we've seen scarcer financing and tightening of these debt situations as we have it now?
I mean, we've dealt with this sort of situation before, where interest rates had to rise, on the back of the need to try and fight inflation, really, particularly from a global perspective. Again, if you look at the spread between U.S. Treasuries and African sub-Saharan African dollar bonds, we've seen that spread widen to over 1,000 basis points in the wake of all of the turmoil in global financial markets. So that remains a major challenge. What this basically does is essentially shut out African sovereigns from the international capital market, at least for this period when this turmoil goes on, because it becomes really expensive to raise funds. Obviously, the risk perception for Africa is much higher, so the ability to raise funds at this time becomes significantly challenged. So those are some of the things that we would certainly be dealing with. But again, I think over the next year or two, things are certainly likely to improve. But in the near term, as these events globally continue to unfold, likely in for a multi-month process that sees this situation resolved, and things can then become calmer going forward.
So let's look at a country like Zimbabwe right now. We know that they've had the world's highest inflation rate off and on, and for the longest time even now, but they're looking to actually cut their interest rate for the second time this year alone. What do we think is going on with Zimbabwe that's giving it this space to do this?
I mean, the idea really is to spur economic growth, right? You've been on this tightening spree. Inflation really itself hasn't necessarily then. You've made money really expensive in the economy. The economy really isn't growing. You get to a point where you realize that you have to sort of free up things, have to become a lot more accommodative with your monetary policy to try and show up growth. I think that's the pivot or the path that Zimbabwe is essentially looking to toe right now.
Mozambique. Mozambique seems to be doing quite well, and they're going to hold their benchmark interest rates in place, even though they have double-digit inflation. But they said that the MPC's proactive response to inflation has meant that the country's real rate has been among the highest in Africa, even with an uptick in the interest rates and the inflation. So what's Mozambique doing right that we might want to look at?
Well, I think, so Mozambique is a relatively smaller economy, and obviously the vagaries of what goes on internationally doesn't have that much of an impact on it. It's really intricately tied to the South African economy, for instance, as is Zimbabwe as well. So I think that it's been able to dodge a lot of the challenges and headwinds that have come with very high inflation. And like you highlighted, the monetary authority, they have been very proactive in raising interest rates to this point where they are having real interest, real return on interest rates at this point in time. So again, it's at the point where they have done some aggressive hikes in anticipation of very high inflation, and it has put them in a position where they can pause and essentially reassess the impact of what it is that they have done, just like Zimbabwe as well. So I think they're pretty much within the same sphere right now.
All right, and let's go to a policy decision that many of us are watching. That's, of course, the expected statement from the U.S. Federal Reserve on Wednesday. We've often said where the U.S. goes, the rest of the world tends to follow. But this also is coming in the midst of the Silicon Valley Bank and the Signature Bank collapses, as well as the Credit Suisse situation, which they're now being bought out by a rival. When we look at the U.S. Federal Reserve, are we anticipating a rate hike there, given the banking turmoil we're seeing now, or will they put a pause on that at least?
I mean, I think this is essentially a case of, market stability versus price stability. Right? The Fed has been on this whole price stability thing for almost a year now, aggressively hiking interest rates. But again, what we've seen over the last week or so is extremely important, right? So the Fed certainly has to decide which is more important for it. Does it want to ensure that it doesn't take its foot off of the gas and ensure that it keeps its eye on the ball and continues to try and bring inflation down, whilst also ensuring that it doesn't spook the financial markets because talking about the last couple of days. So it's a line to thread, but I think that the Fed is likely to do a 25 basis points hike with strong reassuring statements about the state of the financial markets and about the state of, the financial services industry and the banking industry in general. I mean, suffice it to mention that what we have right now within the banking industry in the US and even spreading globally is essentially a crisis of confidence and maybe liquidity issue, really. The FDIC, the Federal Reserve, they've essentially stepped in to guarantee depositors. However, that has stopped short of, reassuring investors and reassuring the public generally. So it's extremely important that the messaging is right and it is consistent to restore confidence. I think it's a confidence issue that we're dealing with at this point in time.
So let me use the word you used at the beginning of that answer, which is spooked. So just how spooked is the global banking system right now? When we look at that spooking, we've talked about issues around the potential of a global recession. Does this push us just that much further towards that, even though it seemed we have been moving back away from the potential of recession in the early parts of the year? And what impact do we think any of these decisions that are made will have eventually on African economies and our own presence in the global scheme of things?
Well, I think the issue is just all of the uncertainty, right? I mean, we don't know who else is going to implode. We don't know what else is under the hood, so to speak. I think that uncertainty is the major challenge right now. So again, we'll see how things pan out for the rest of the week. Hopefully, we don't get any situation where another bank comes up to say, it needs help or anything like that. I think that the bigger issue was the whole Credit Suisse issue, which obviously had a much stronger global footing with its tentacles globally. I think that, the Swiss government stepping in to take care of that situation should go a long way in assuaging the nerves of, the markets and investors in general. I mean, the pieces of that will be picked up. A lot of analysis around, the impact of that will certainly continue to go on. But I think that, it is important that we deal with the crisis of confidence that we have right now. And have an impact on the African economies, really. The truth of the matter is that, these tend to create a situation where the risk premium on Africa just essentially rises, at this period. I mean, if you're perceiving, risk in, more developed, more advanced economies, and then the risk perception here just continues to grow. And it has certainly very strong implications for pricing of our assets here as well. So I think those are some of the issues that we'll certainly be dealing and grappling with over the next maybe couple of months.
All right, Victor Aluyi, thank you so much for joining me. We await the decision from Nigeria's MPC, also the decision tomorrow from the Federal Reserve, and we'll see how that balances out, especially also in light of some of the banking situations happening around the world right now. Thank you for your time today.
Thanks for having me.